It's often said that valuation is an art and a science. Well, as a valuer and as a business valuer, I could say that's probably right. As a business owner, if you're looking for someone to value your business, what's critical is you need to select a valuer that understands the nuances and the market differences and peculiarities of your business versus others in the market. It's not necessarily a simple process to value a business. And to give you an example, just to make the point, I've selected two companies that we've recently valued, Company A and Company B. They're both in the industrial services market in Australia, and they're both family businesses. And we've valued these businesses over the last 12 months. Business A has a turnover or revenue, in other words sales, of about 1.5 million. Business B, 3.5 million. So a slightly bigger, larger business. It's been operating for a little bit longer. In terms of clients, number of clients, Business A has 50 clients. Their average spend in terms of sales a year is about 30,000 average. Business B has less clients. So only 20 clients in the last financial year with an average spend of 175,000 each. Interestingly, if you look at that client base for Business A, no client represents more than 10% of revenue. So there's quite a spread of the sources of revenue for Business A. Whereas for Business B, one client represents 30% of the revenue in the last 12 months. So almost a third of revenue coming from one client. Now, thinking about valuation, how would a valuer assess these two companies? What would they look for? Well, the first thing we do is look at the health factors of a business. And I've already alluded to the fact that this business has a very interesting spread of clients. There's no concentration risk here with one particular client. Whereas Business B, 30% of the revenue is sitting with one client. Now, that could be a positive, but it could also be significantly a negative. Is there a risk that this revenue and this client may move to a competitor? Now, perhaps there's a longevity of spend over many years that's grown, and there's a strong relationship, perhaps backed by a supply agreement, which might mean that there's not such a risk of flight of this revenue. But if those things aren't in place, then there is a risk that if this client leaves to a competitor, future maintainable earnings for this business could be seriously at risk. And ultimately, valuation, looking at business value, is about the future maintainable earnings of a business. They are the earnings today and how they're going to be represented in the next year and the next year if the business is operated in a similar manner. Now, both these businesses are actually profitable, but you can see that they have different health factors. Then you get to the value range. Industrial services, typically businesses are valued between 3 and 5.5 times earnings in the current market for this size and shape of business. Now that's very interesting because that's a huge range. And you might say, well, how do we know what our business is valued at? Well, it all comes down to these health factors and some of the issues that I've talked about here today in terms of the differences. So if you're looking for a valuer to value your business, to help you grow and change the value of your business, look carefully to make sure that valuer understands the nuances, both in your business and in your market sector, because they're going to be best placed to give you a true indication of the likely fair market value of your business depending on the scope of the valuation. I hope this has been of interest, and if you're interested in more topics like this, then subscribe to our channel. We'd love to share some more on how to grow and change the value of your business, and we intend to over the coming months and weeks. Thank you.